Okay, welcome to the session on economics, economic sciences. My name is Anders Hector. I'm Science and Innovation Counselor at the Embassy of Sweden. I'll be your moderator for this session, and you're very welcome in this room and online. And online you can choose channel if you want English or Korean, and you can ask questions in text. And in the room, of course, you can go to nobelmemorialprogram.kr and write your question, or we can probably have some time to state it also. Before moving into the keynote speakers, I would like to invite to the floor the Ambassador of Sweden to the Republic of Korea, His Excellency Daniel Wolvén.
Thank you, Anders, and welcome to our new guests, and for those who were here for the previous symposia, welcome back. I have some prepared remarks, but I wanted to depart from those a little bit to say I started my previous introduction saying that the specific objective of these symposia is to stimulate curiosity about the Nobel Prizes, and I think the previous sessions did exactly that. We will now turn to a different subject, economics, and hear about the research on banks and financial crisis, which I think is a very apt and interesting topic for today. As any event that we organize, this would not be possible without partners, and I really want to extend my heartfelt thanks, especially here to the Korea Development Institute for partnering with us for this particular session. So with that, again, thank you so much for being here, and I really look forward to the next session. Thank you.
Thank you, Ambassador. And for this session, we have a valued partner in Korea Development Institute, and I would like to invite to the stage Jung-Kyu Lee, Senior Vice President and Senior Chief Management Officer of Korea Development Institute, KDI. Please, Mr. Lee.
예, 안녕하세요.
Good afternoon. I am Jung-Kyu Lee, the Vice President of KDI. It is indeed an honor and great pleasure to be co-sponsoring such a significant event as the Nobel Memorial Program together with the Sweden Embassy in Korea. I would like to, first of all, thank the host of this symposium, the Swedish Embassy, as well as the Ambassador. I'd like to take this opportunity to first extend my gratitude to the Swedish government and Ambassador Daniel Wolvén for hosting today's event. And my thanks also goes to Professor Christopher Jedring from Lund University, and also to Dr. Sung-Hyuk Lee of KDI and Professor Ki-Young Lee from POSTECH as well, who at first declined to accept the invitation. For myself, personally, I'm very much looking forward to today's session. Recently, we have been hearing a lot in the news about possible economic crisis and global economic recession. Even without the news report, we're able to feel for ourselves the sharply rising prices in our everyday lives. The interest rate is rising in tandem with inflation as well. So it is in this situation that the Nobel Prize Committee has elected 3 economists as the joint winners of this year's Nobel Prize in Economics. Their research focused on the potential for bank run to resulting from the panic in the market and a breakdown of trust, and what the government should do in this situation. So the key word that runs through all of the contributions for this year's prize is bank run. And So the Nobel Committee believes that our capability to counter such a crisis has been enhanced by the contributions by the winners. So I think it is at this juncture that we can sense the deliberations of the Nobel Prize Committee over the recent global economic situation. So in this context, today's symposium is of utmost importance. We come to reflect on the significance of the Nobel Economic Prize, and so this will have important implications for responding to the challenges that may come upon the financial market going forward. I sincerely hope that today's program will serve as an opportunity for all of us to understand how to interpret the current situation and what the government should do to respond to this challenge. Thank you very much. I would like to thank everyone for attending today's event. Thank you.
Thank you very much for those kind words. And we will see more of your colleagues in a while. So this is the third year that we're doing the Nobel Memorial Program. And all the time we have fantastic support from Swedish universities. And for the first time we have the universities here. And I'm very happy to physically welcome to the stage Dr. Lena Eskilsson, Vice Chancellor of Lund University. Please.
Thank you. Your Excellence, colleagues, ladies and gentlemen on site and online, I'm given the honor to hold this welcoming address. I'm from Lund University, and I'm not the Vice Chancellor, I'm the Deputy Vice Chancellor. But I represent all three Swedish universities, Lund University, Umeå University, and the Royal Institute of Technology. And we are a large delegation coming from Sweden to Korea to celebrate science and to be a part of the Nobel Memorial Program. And as said earlier this afternoon, science are without borders, and it's important to collaborate, both within the country, and Sweden is a very small country, and across borders. One of my colleagues from Lund University, he wrote his PhD about creativity and the Nobel Prize winners. And one of his conclusions were the importance of meetings and the importance of meeting places to foster new ideas and to foster creativity. So I'm so glad that we could finally meet here in person. And as we talked about yesterday, during the interesting sessions yesterday, when people meet, things happen. So a big thank you to Seoul National University for hosting us today, and a big thank you to Korea Development Institute. And it has been such an interesting program and sessions this afternoon. But being a social scientist myself, I'm especially looking forward to this session, the economics session. So let the show begin. Thank you.
Yes, let the show begin. And the show will continue with two keynote speakers and an additional panelist. And the keynote speakers will talk for about 20 minutes. And the first keynote speaker is Professor Christopher Edling. He received his PhD from Stockholm University in 1999. And before coming to Lund in 2012, he had positions at Stockholm University, Uppsala, and Jacobs University. His research applies network analysis to various social phenomena, drawing mainly on survey and register data. He serves on the board of the Wallenberg AI Autonomous Systems and Software Program, Humanity and Society, and he is a member of the Royal Swedish Academy of Sciences and a member of the prize committee for the Sveriges Riksbank Prize in Economic Sciences in memory of Alfred Nobel. Translating to, that's the committee where they discuss and agree on who should be awarded the prize in the economic sciences. I'm very happy to welcome you to stage, Christopher, please, for your presentation.
Yeah, so you already got the introduction, so I will jump right into it. This talk is based completely on the scientific background for this year's prize, which is a document that you will find at the address listed here, nobelprize.org. I recommend this document, particularly for students who are interested in the topic. It's a thorough sort of review of the area with lots and lots of very useful references in the end. So I will do a very sort of straightforward presentation of this year's prize. I'll say a little bit about the prize committee and the committee work. I will introduce the laureates and then go through the three sort of contributions that make up the motivation for the prize. As you probably know, when Alfred Nobel wrote his will in 1895, economics was not one of the 5 prizes that he came up with. He wanted to have prizes in chemistry, physics, physiology, literature, and peace, which we still have. So the prize in economic sciences is not a Nobel Prize, but it is a prize in honor of Alfred Nobel. It was established in 1968 to commemorate the 300-year anniversary of the Bank of Sweden, Sveriges Riksbank. As you said, Anders, the full prize, the name of the prize is Sveriges Riksbank's Prize in Economic Sciences in honor of Alfred Nobel. It's particularly important to keep this in mind when you talk with the sciences, for instance. So we don't want to mix up honorary prizes with real Nobel prizes. However, in all practical regards, the Royal Swedish Academy of Sciences handles the prize in exactly the same way as it does for the prizes in chemistry and physics. Nominations, selection processes, and the presentation of the prize is very similar. What I would like to highlight is that it is a prize in economic sciences. So this is economics broadly defined. And also, according to the statutes, it is a prize to reward contributions that have conferred the greatest benefit to mankind, just as Nobel stated in his will. It is given strictly for the contributions. It is not a policy or lifetime award. The prize committee is selected by the class of social sciences at the Royal Academy of Sciences. The majority of these 10 to 11 members are economists, but a couple of us are not. I'm one of them, so I'm trained in sociology and I am a sociologist. And this is to have representation from sort of neighboring disciplines. Every year, the Academy invites a large number of scholars to nominate candidates for the prize. These nominations are screened by the prize committee, and the committee then asks international experts to assess the specific candidates and the specific contributions. And this process generates quite a large number of reports, and much of the prize committee work constitutes reading through these reports and trying to come to some sort of conclusion. At the start of the year, we start out with maybe 10 to 12 suggestions for this year's prize, and that is then reduced over the fall and spring and summer. And in September, a final suggestion is made to the class and to the Academy alongside a report. The Academy decides in October, and the prize is awarded in Stockholm on December 10. So we're still looking forward to this year's celebration. It's important to also keep in mind that the committee work on a prize suggestion for many, many years. So it's not only the fact that we reward contributions that are done years ago, but the prize work in itself is also runs over several years. I don't think that there are any researchers that ever had their work scrutinized in such a way as the laureates for the Nobel Prizes and for the Economics Prize. This is probably the most rigorous peer review process that we have in the world. So, the Sveriges Riksbank Prize in Economic Sciences in honor of Alfred Nobel for 2022 rewards research on the role of banks in the economy and particularly during financial crises. The prize motivation is for research on banks and financial crisis. It's awarded to Ben Bernanke, born in 1953, a PhD in 1979 from MIT. He is now a senior fellow at the Brookings Institution in Washington, D.C. Douglas W. Diamond, born also in 1953 with a PhD from Yale from 1980. He's a professor of finance at the University of Chicago. And Philip Dybwig, born in 1955, but with a PhD from Yale from 1979. He's a professor of banking and finance at Washington University, St. Louis. As you see, these three laureates are almost exactly the same age. They received their PhD at almost exactly the same point in time, and they made their prize-winning contributions at almost exactly the same point in time. And that point in time is roughly 40 years ago. And interestingly enough, the chunk of the work that they are rewarded for was done when they were PhD students. So the research originated in the early 1980s, motivated by the experiences of the banking sector during the Great Depression in the 1930s, which we know as the deepest and longest economic downturn in recorded history. It began in the US, but it became global. The committee argues that the research has significantly advanced our understanding on the role of banks, the role that banks play in the economy, particularly during crisis. And that this research shows why it is important not to let banks go under or collapse. Diamond and Dybwig developed theoretical models on the role of banks. Ben Bernanke addressed the role of bank failure in empirical studies of the Great Depression. So this year's prize is interesting because we all have a sort of relationship to banks in one way or another. We place our regular income in a bank account and we use banks' means of payments, maybe mobile banking apps or banking cards when we shop at supermarkets or pay restaurant bills. At some point in time, many of us also take out a fairly large loan in the bank to buy a house, for instance. The same applies to companies. They need to be able to take out loans to make new investments, finance investments. And in most cases, this is done through a bank or a bank-like institution, maybe we should say. But we take for granted that these services function as they should, perhaps with the exception of brief technological hiccups when the net connection goes down for a while. Or the computer loses its current. But sometimes the bank system or parts of the system fail and a financial crisis arises. And important banks collapse. Borrowing becomes more expensive or impossible even. Prices plunge for property and other assets. And if this progression isn't stopped, the entire economy can enter a downward spiral of rapidly increasing unemployment and bankruptcies. And some of the biggest economic collapses in history have been financial crises. Now, the three laureates' contributions are published, nicely enough in three different papers. And these papers provide complementary insights, which we claim have long-lasting impact on research and on policy. In a paper from 1983, Diamond and Dybwig developed a theoretical model explaining how banks create liquidity for savers while at the same time borrowers can access long-term financing. This is a simple model, but it captures central mechanisms of how and why banking works. They also showed how this system is inherently vulnerable to bank runs and consequently why we need a system that regulates banks. In 1984, Diamond published a paper on the conditions for banks to take on the task of monitoring the borrowers in order to ensure that the borrowers honor their commitments to the bank. Moreover, he showed in that paper that if a bank fails, the capacity to monitor is difficult to rebuild, and it takes time to rebuild and replace. And lastly, firstly, but not lastly actually, Bernanke's paper from '83 demonstrate how failing banks played a decisive role in the Great Depression. This is the worst economic crisis that we have on record. And Bernanke's work show us why the banking system, why the downturn of the banking system made this such a long-lasting and deep depression. Together, these findings, as I said, they reinforce each other. They offer insights on the beneficial roles that banks play. They explain why banks are vulnerable and how that vulnerability can lead to devastating crises. And this work has proven very important for policymakers. Actions taken today by central banks and financial regulators around the world confronted two major crises, the Great Recession of 2008 and the COVID-19 pandemic, all show traits of action taken by banks, central banks that are motivated by this work. So I'm going to tell you a little bit more of each of these paper now. It's said actually that this paper originated when Diamond and Dybvig were PhD students at the same time, and they had the same supervisor, and the supervisor didn't have office hours, so he expected the students to wait outside of his office until there was time to be received. And they would sit outside munching on cookies and discussing problems that they would like to work on together. And so the idea for this paper is said to have come up during that conversation. They wrote it after they had their PhDs, but they have been colleagues since graduate school and still are. To understand why a banking crisis can have such enormous consequences, we need to know what banks actually do, and this is what Diamond and Dybvig are trying to answer. Banks receive money from people making deposits, and they channel it to borrowers. There are fundamental conflict between the needs of savers and investors, and this intermediation is therefore not a simple mechanical transfer. Someone who takes out a loan to finance a home or a long-term investment must know that the lender will not suddenly demand their money back. And on the other hand, a saver wants to have at least some of their savings instantly available for unexpected outlays. So Diamond and Dybvig explain how banks naturally arise as intermediaries to provide this solution. The bank offers accounts where households can deposit their money. The bank then lends the money to long-term projects. And depositors can withdraw their money when they want it without losing as much as if they had made a direct investment and terminated a project early. So these higher returns are financed by households that save for longer and thus give up some of their long-term returns compared to if they made a direct investment. So this is why we receive a lower rent for our deposits than we pay for our loans. So Diamond and Dybvig show that this process is how banks create liquidity. They create money in the process. The money is in the depositors' accounts, and this is a liability for the bank, while the bank's assets consists of loans to long-term projects. The bank assets have a long maturity because it promises borrowers that they will not need to pay back their loans early. On the other hand, the bank's liabilities have a short maturity because depositors can access their money whenever they want. So the bank is an intermediary that transforms assets with long maturity into bank accounts with short maturity. And this is known as maturity transformation, and it's one of the central contributions in this year's prize. And it's easy to see why this is valuable to society. But they also argue in this paper that the business model makes banks fragile and subject to self-fulfilling bank runs. The problem arises from the fact that if the bank had to liquidate all long-term investments early, there would not be enough funds to cover all the deposits. If a depositor believes that the other depositor will withdraw their funds from the bank and thereby force the bank to liquidate long-term investments prematurely, she will also run to withdraw her deposits from the bank before the bank runs out of funds. So what the model claims is that you have two equilibria. You have a good equilibrium where this maturity transformation works the way it should be, but you also have a bad equilibria where people run to the bank, take out all the money, the bank runs out of funds. First they claim back all the money from the borrowers, and then they run out of funding. So we need to somehow stay out of the bad equilibrium, and this is where regulation comes into play. Even fundamentally healthy banks can get into trouble from this model, so you don't have to be a bad bank in any case to be vulnerable in this respect. So bank runs the risk of bank runs is widespread, and therefore we see policies such as insurance deposits and lender of last resort mechanisms in almost every countries nowadays. Diamond is the author of the second paper that is rewarded in this year's prize. This paper is actually a chapter from his PhD thesis originally. So this is PhD work, which is also interesting when you consider a long career, someone who's been in the field for 40 years and is now rewarded for something he did as a PhD student. It's kind of good news, I think, for students. That, and also an invitation to stay agile also as a student. This might be the best times, the most productive years of your life. Anyway, so Diamond claims that in reality most investments are risky, and the return on investment depends on factors such as general uncertainty and how well the borrower has done their job. Now, a borrower could try to avoid paying back a debt by claiming that an investment failed due to bad luck, for instance. And to prevent this, it has to be costly for a borrower to go bankrupt. However, even borrowers who have done their jobs well and not wasted any money can sometimes go bankrupt. And this creates unnecessary costs to society. Now, Diamond's analysis on the conditions necessary for banks to take on the task of monitoring borrowers. So this is the problem. How do you monitor the borrowers and make sure that they honor their commitments? Without the bank, if we didn't have the bank, this type of monitoring would be very, very difficult and very costly for me as a depositor. All the individuals who have made a direct or indirect investment in a project cannot really handle the monitoring by themselves. Instead, the monitoring is then delegated to a bank. And a bank can reduce the monitoring cost by using expertise in evaluating and monitoring borrowers, and by pooling funds from many savers and diversifying across borrowers. And this enables households' savings to be channeled to productive investment for a lower cost. But if the bank is monitoring the borrowers, then who is monitoring the banks? Diamond asks. And he concludes that the way in which banks are organized means that they do not really need to be monitored by the depositors. A bank risks large losses if its loans, if the bank cuts corners on monitoring borrowers. It would be unable to repay what it's promised its depositors and therefore collapse. And it is therefore in the bank's own interest to monitor its borrowers without the depositors' need to monitor the bank. So it's interesting to note that monitoring requires knowledge that disappears when a bank fails. So this whole delegated monitoring mechanism is really a sort of a knowledge base. And this knowledge takes time to build and to recreate. So if a bank fails at the same time as they did during the Depression, many banks fail at the same time, the cost of credit intermediation increased dramatically and much of the economy just stops functioning. So the consequences of bank failures are not only very negative, but because of this delegated monitoring mechanism, they are also long-term because it takes such a long time to rebuild the capacity to monitor borrowers. So Bernanke's study on the role of banks in the 1930s is really empirical work that adds to the or shed light on the theoretical work of Diamond and Digwig. So he shows that when banks failed in large numbers, existing bank relationships were destroyed and it took a long time to rebuild new relationships. And the result was, as the models would predict, a severe credit crunch, primarily affecting households, farms and businesses. And this deepened and prolonged the Great Depression. So Bernanke provides empirical evidence that financial intermediaries perform a valuable service by channeling savings to productive investment. And by disrupting these services, the banking panics in the early 30s generated such a long and deep recession at the time. So Bernanke's works provide evidence that supports the contribution of Diamond and Dybvig. Specifically, Bernanke showed that bank runs can lead to financial crisis as modeled in the Diamond and Dybvig model. And this in turn leads to prolonged periods of disruption of credit intermediation that is consistent with bank failures, destroying the valuable screening and monitoring services that banks perform, as in Diamond's theory of delegated monitoring. So, the research by Bernanke, Diamond, and Dybvig gave rise to the modern theory of banking, which today forms one of the pillars of economics and finance. The work that has followed provides a framework that guides regulation. So I don't think we can say that they tell us how to do it, but they tell us what the important factors are that one needs to look at as a regulator, as a policymaker. The emphasis on microeconomic foundations has made the theory applicable to many different types of financial intermediaries, which is also important. And it helps researchers analyze the consequences of the evolving financial landscape. Now, the Great Recession in 2008, the problem there was primarily the so-called shadow banks that were not regulated as banks. So it seems that regulations is always one or two steps behind. But the theory still applies to those institutions, even though they are not formally known as banks, but they serve the same function in the financial landscape. So changes in technology and regulation lead to new types of institutions that enter financial markets. These institutions compete with traditional banks, and they even replace traditional banks. And new actors still perform the same fundamental functions, and they are subject to the same underlying fragilities. So therefore, financial regulation must also evolve, and this research is used to evaluate the various policy tools that are possible at preventing and combating economic crisis. Now, policy intervention, such as deposit insurances, do not only come with benefits, there are also potentially significant costs. Many have observed that excessive protection of banks can lead to moral hazards, and it may contribute to growing inequality. But also in such debates, the theoretical frameworks that are rewarded in this year's prize help policymakers by highlighting relevant economic mechanisms and trade-offs that need to be considered when designing financial policy. So, for research on banks and financial crisis, I give you the Prize of Economic Sciences 2022. Thank you.
Thank you, Professor. That was very interesting. I'll invite you later back to the stage. But first, now I would like to invite the next keynote speaker, that is Sungyup Lee, fellow at the Department of Industry and Market Policies at Korea Development Institute. Please come to the stage, and you can choose if you want to make a presentation from the pulpit or from sitting down. The pulpit, okay. I'll say a few more words about you in the meantime. Dr. Lee is a research fellow at KDI. His research area include asset pricing, capital market, risks management in the financial sector, and the interaction between financial markets and corporate investments, with a particular focus on the role of real and institutional frictions. Recently, he also performs policy research on the digital transformation of financial markets. Dr. Lee received a PhD in business economics from Harvard in 2018 and holds a bachelor's degree in mathematics from Princeton University. Before joining KDI in 2021, he worked as a financial economist at Cornerstone Research. A most welcome, Dr. Lee.
네, 안녕하세요. 저 KDI 이승엽입니다.
Hello, I'm Lee from KDI. So, the winners of this year's Nobel Economic Prize, we need to really reflect on their contributions. And so I am extremely grateful for this opportunity to dwell on that topic. And to Ambassador of Sweden, Mr. Daniel Volven, and others, I would like to extend my heartfelt gratitude for inviting me here today. In the case of this year's prize, the financial institutions, their role, and also when these financial institutions fail, what kind of financial crisis can happen and the consequences to the economy. So, to talk about this, we need to talk about the role of the financial institutions as financial intermediaries. So here, financial institutions refer to the entities in the financial market. So we have capital, and this capital will be conveyed from those who have the resources to those who are in need, and information is produced in the process so that it can be efficiently allocated, and among those who have the resources, risk will be allocated in an even manner so as to maximize the investment returns. I think therein lies the role of the financial institutions. If you look back at the history of financial industry, so various financial contracts to achieve these ends were developed, and these new financial techniques, in order to implement them well, how these financial institutions were organized and how they evolved is what forms the financial history. So here, among the financial system, the bank is the most important. I think nobody would disagree with that. If that is the case, then we take it granted for the fact that banks exist, but they weren't there from the very beginning. So what kind of benefits did banks offer so that they evolved to this very day? And also, we're continuously talking about the financial crisis, and at the core of financial crisis lies banking systems as well. But the financial crisis, they're manifested mainly through the banking system. And if it has a large impact on the overall economy, then through the banks, these various financial contracts are implemented. Deposit is the most representative case. What kind of vulnerabilities is there so that these consequences, negative consequences, can take place? And finally, the banking system, when it fails and when it leads to a collapse of the financial system, it would have negative consequences for the entire economy, and that is a well-known fact. But what process would lead to that consequence? So those are my 4 questions. The Nobel Prize winners, their contribution can be categorized into the following 2. First is that the various economic phenomena, I'm talking about the economic prize, right? So in order to understand these various economic phenomena, if a framework has been provided, then that's counted as an important contribution. And also in understanding the world, there are many theoretical and empirical evidences, and then methodology is required for that, and a contribution can be done in the methodology area. So I believe for this year, the contribution is in the former. So Diamond, Divik, and Bernanke, they have provided a framework to understand the role of financial intermediaries, the nature of financial crisis, and the consequence of financial crisis on the real economy. They have provided a canonical framework to understand all of these. So these 3 winners, we will look into the contributions by each. So the first paper was written in 1983 by Professor Diamond and Divik. And so in the bank, the financial contracts, for instance, if we place a deposit, there's a deposit contract. What kind of characteristic does this contract have? So many people would deposit their money in the banks, and they're not well aware of when they will be needing this money in the short term. So some people will be in need of short-term need, and some people might have need in the long term. And so these risks are pulled together, and it is distributed. This kind of mechanism is provided by the banks. That is at the core of the paper written by Diamond and Divik. Through this mechanism, an uncertain liquidity need, despite that need, socially, in a very effective way, investment can be made. However, according to their model, efficient capital investment. There is good equilibriums that allow for this, and there's also bad equilibriums for this, and that is the bank run. So this bank run phenomenon is something that I will revisit through 3 concrete examples later on in my presentation. So at the core of bank runs, if in fact nobody withdraws their deposit, then despite the fact that the banking institutions are solvent, because of this self-fulfilling prophecy, people rush to the banks in order to withdraw their funds because they want to be there first, because others will be there as well. And so everybody will run to the bank, and the long-term investments that have been implemented at the bank will be all invalidated, and so great inefficiencies will take place. Then secondly, in 1984, there was a paper by Mr. Diamond. So this is about the role of and the function of banks. They are delegated monitors. But before that, to companies with good projects, they will be screening these companies to allocate money to that project. But this is something that investors cannot do themselves, and so they're delegating this role to the banks. And then who will be monitoring the banks? That is an issue that might arise. But in the case of Mr. Diamond's paper in 1984, according to that paper, this kind of agency issues, I have entrusted money to the bank to make efficient investment. There is a possibility of the bank not doing that. And so this agency issue, and the investment decision is not related to that agency issue. And so the model show that the agency problems at the level of intermediary will be low to the extent that the intermediary invests in diversified set of investments. So the bank is so it produces information about the possible investments, and so this is the most efficient form of information production. And afterwards, this evolved. Mr. Diamond, with Rajan in 2001, wrote a paper on how the deposit can be used in other ways. So if the banks are not taking care of these agency issues well, then by withdrawing their deposits, the deposit holders can punish the banks, and so they try to interpret deposits as a disciplinary device. And also there are indirect and both direct investments that can be made. So we can buy securities in the securities market, for instance, or we can also buy debt in the bond market as well. The characteristics of the company and what kind of reputation that company has would determine how these bonds are sold. So there's the direct financing market and the indirect financing market, how they are organized, and how the banks raise their funds was also allowed to be understood by these papers. And the very starting point was provided by the paper that was written by Professor Diamond in 1984, which allowed him to win the Nobel Prize this year. So dispersion of risk and the production of information. These two functions is very important for the bank. If that fails, what happens? So in the case of Mr. Bernanke, in his 1983 paper, it analyzes the data from the Great Depression. And if the banking system fails, it will have protracted and very serious consequences for the real economy. That was empirically demonstrated. So this was written in 1983. Up until the 1970s, the economists viewed the world from a very broad framework. There's a real economy, and the financial world is like a sideshow to the real economy. It just reflects the real economy. But it was proven that that was not the case. So the financial world will be interacting with the real economy, and the very grave consequences can generate if one fails. And research on this topic started to come out in earnest in 1980s, and at the very starting point was this paper by Mr. Bernanke. So we talked about the bank runs at the start of this presentation. Do we still have bank runs as we have had in the past? Just because you're nervous, do we run to the banks and withdraw our deposit? Yes, they do exist nowadays as well, as we will see later. However, the form has become different. In the case of Diamond-Dybvig model, there is it can be seen as a failure of consultation. I don't do it and you don't do it, and there's a good social result. But if you do it, I'm going to do it, and everybody runs to the bank, then that will lead to failure of social negotiation or consultation, and that will lead to a bank run. So from that perspective, bank run is simply purely a liquidity problem. However, the world nowadays does not function in exactly that manner only. So bank runs, in fact, investors or deposit holders running to the banks, rather than them trying to withdraw their money from the bank, bank runs would not happen because of that. Liquidity issues or lack of solvency of the bank will lead to bank runs in the modern world. So in order to narrow this gap, there were follow-up research undertaken. And so if you look at the literature, the assets that are held by the banks, the asset quality, or others, if there is uncertainty about the asset quality of the banks and the investors do not know about that, the equilibrium can be a bad equilibrium and can lead to a bank run. So it's not about bank runs being inevitable, but when the trust of the investors of the bank collapsed, then bank runs will take place. In other words, the bank's soundness, if the concerns of the market over the solvency of the bank, when these concerns grow, and at a certain point, if it reaches beyond that point, then bank runs may take place. So I'm going to give you some examples. As you're probably well aware, in 2011, this was the mutual savings banks crisis in Korea. So mutual savings banks, the MSBs, they appeared and has grown phenomenally after the 2000s. So after the IMF, after we liberalized the financial market, because we needed to provide business models for different sectors of the economy. A lot of deregulation took place, and so PF lending was allowed, and there was a lot of investment that went into the property market. The problem is, in 2008, after the global financial crisis broke out, much of these loans and money became insolvent. So in early 2011, out of 7 trillion PF loans, 3.4 trillion was considered as non-performing. Despite that, however, these MSBs, because of the sudden deregulation, they did not have the necessary compliance system in place. And through window dressing of their accounting, they were concealing these non-performing assets. But in 2011, the financial regulator, the FSC in Korea, deemed that the problem was too serious, and they ordered one MSB to suspend their business. And so this led to greater level of concerns in the market. And 2 more mutual savings banks were ordered to suspend business in February 2011. And then suddenly people came to realize that this was not a problem confined to a single savings bank alone. It was a structural problem. This was recognized by the investors. And so those people who had deposited their money in the savings bank, they all ran to the banks and rushed to withdraw their money. So a lot of things happen, interesting things happen. So bank runs can happen for those banks that had a lot of non-performing loans. But even those solvent savings banks experience bank runs. And this is because the market's concern or suspicion level of the assets that were held by these banks had gone up and exceeded a certain point. So these two photos are about the bank run incidences that took place in Korea. And another photo is about a financial institution which was solvent, but because of the market suspicions, there was a bank run on this bank. And so in order to prevent the deposit holders from rushing to withdraw their funds, people stood in front of banks trying to stop them from withdrawing their funds. So, as we have noted in the previous presentation, bank run. To prevent bank runs, there are three ways. First is the prudential standards, the capital adequacy ratio, and secondly, central banks working as a lender of last resort, and thirdly, deposit insurance. In the case of the mutual savings bank, compared to commercial banks, they had much less strict prudential standards, and at the time, the savings banks did not have access to liquidity support from the central banks. And thirdly, there is the deposit insurance. It was there. It was already in place back then, but because this was the first of such crisis in Korea, because there was lack of trust about these savings banks back then, despite the fact that deposit insurance existed, bank runs had taken place. So what should be done in the event of a bank run? So at the time, the regulators suspended people from withdrawing their money. So this was a signal sent to the market that if you're going to do a bank run, this is going to be suspended. And that meant that people who really needed money back then could not withdraw their funds. So this was quite excessive. If this was indeed a liquidity crisis, then it should have been the case where the government provided liquidity. However, this was not the case. There were actually insolvent banks. But then other banks who were not, insolvent. So in those cases, these banks had to promote themselves. How they were not insolvent, they needed to provide more information that was required by the law in order to regain and maintain the trust of the market. And secondly, the Asian financial crisis that took place in 1997. Already so many people had talked about this, but at the time, because of this outcome, the banking system of Korea, we had a chance to look into the fundamental issues or problems that our banking system had. So a lot of banks were reliant on the short-term capital inflow from overseas. A lot of banks from the advanced countries had borrowed short-term capital, and then they had lent these monies in the form of long-term borrowings to Southeast Asian countries. And so with regards to risk of maturity transformation, there was very low understanding and awareness in the market at the time. And because of the sudden liberalization of the financial market at the time, there was a lot of capital inflow coming into the Korean market. And so there was a lot of liquidity abounding. And so as has been seen in the Diamond's paper, the banks, despite the fact that they should have served a very prudential role as agents, that was not actually what had happened. As you can see on the table on the bottom, the short-term debts compared to long-term debts was not that much. However, if you look at the banking sector alone, most the short-term debts, they exceeded the long-term debts. And also, the banks' short-term debts actually compose most of the total short-term debts of the country. So in this situation, the market, with regards to the Korean economy, when the investors demanded repayment, when they had suspicions about this ability to repay, what should we do? So this is an international market, so there is no deposit insurance. We cannot suspend the withdrawal, and there is no lender of last resort. Of course, IMF intervened to serve as the lender of last resort, but unlike a central bank, they cannot provide liquidity in an unlimited fashion. And so when a small amount of liquidity was provided into the market, then there were foreign capital who rushed to take this money. And so there were side effects actually created by the IMF in liquidity. And so what should have been done? We should have regained the trust of the market. We should have paid very high interest rates. So in the private market, when there is a bank run, the banks can say that we can provide very high interest, so don't do a bank run. But can the banks really persuade the deposit holders that this will be the case? But it's not really successful. If I don't withdraw my money, then others will go and rush to withdraw their money, and that I will be left without my money. That's the kind of thinking that people would have at the time. So people would not be persuaded by these kind of efforts on the part of bank. So the IMF program failed because of this very reason. What was effective then? In the case of short-term debt, the debt was rescheduled. It was not much different from a moratorium, but this was quite successful because IMF, US, and the Korean government in the early part of 1998, this was successfully carried out. And so in the market, the international community, especially the IMF and the government measures, the international markets regained their trust in the measures that were taken by the IMF and the government. And so they no longer saw the need to demand repayment of their debt. According to the model by Diamond Living, in the case of the suspension of convertibility, how many people need short-term liquidity and how many people don't have this need for short-term liquidity? So suspension of convertibility only works when we know which people have such needs. However, but how many percent need short-term liquidity? How many percent of people don't need this liquidity? Something that could not be really assessed. However, there were a lot of small institutions that lent money to us, and we were able to adjust the debt in a very successful manner.
Look at the financial crisis. Because Korea's economic fundamentals were weak, some people say that the sudden reversal of capital flows take place because we had weak fundamentals. And other people say that it was just reaction of a nervous market, just a occurrence of bank run. And both are valid assumptions. When in the beginning stages of the panic, there was a lot of concern about the weak fundamentals about Korea's economy. And later on, when the bank runs actually set on, the development of the crisis did follow the course of bank runs in the financial panic hypothesis. So in this situation, to maintain the desirable equilibrium, there are a lot of solvency and prudential measures that are taken. However, if we are already at the stage of undesirable equilibrium, it could actually have a negative impact on the situation, and that was a lesson that we learned from the IMF bailout. This is because when we were first getting the bailout, we were already in the stage of undesirable equilibrium. And so the market had to recover its credibility and trust. So the non-performing institutions had to be closed down. But if we were at a good equilibrium, this could have provided more trust to the market and helped us maintain our status at the good equilibrium. However, if we're already in the negative equilibrium, the banking system can become very insolvent and have a more negative impact across the economy. So insolvency of the banking system means that the banking functions do not work. In particular, the developing economies back at that time, which included Korea, didn't have a very well-developed capital market, so they had to rely very much on banking systems. And if they are heavily depending on banking systems, then this could lead to even more severe consequences. And lastly, I'd like to share briefly about the global financial crisis. If banks collapse, why is this particularly more important and significant than other financial institutions collapsing? This was the most important part of this year's Nobel Prize in Economics, because the 2008-2009 global financial crisis, everyone understands that it was because of the insolvency of subprime loans. But the losses of the subprime losses were in the early stages around 250 billion, but they later raised and increased to about $1 trillion. Now, this sounds like a very massive amount, but compared to the IT internet bubble that in the early 2000s, when the bubble bursts in the stock market, the money that was lost on the stock market amounted to $5 trillion in tech companies alone. However, the IT bubble bursting only went through a brief recession, and then the economy bounced back. But the global financial crisis had much deeper and long-lasting impacts across the global economy. This is because of the following. The internet bubble, this internet bubble bursting did affect the wealth of the households. However, at the same time, the bank's financial intermediary role had not been impacted, and most household debt is borrowing not against shares, but they're borrowing mostly against their home equity. And the property market at that time had not been impacted very much. So the bank's financial intermediating role was intact. And so even though there was a large impact on the capital market, it did not lead to a long-lasting financial crisis. In contrast, the global financial crisis of 2008-2009 had larger and longer reverberations because the banking system had been impacted. Now, when the financial system collapsed, why were the banks most significantly impacted? Before the global financial crisis, the shadow banking had played a certain role. If we look at the diagram at the top, in the past, households would save their money in banks and banks would invest that money. And so banks would serve the role of supervision and management, and households would be able to diversify and distribute their risk. So this would be the optimal allocation of resources. But in shadow banking, more households would not directly save their money in banks in form of deposit. They would actually be investing in short-term investments such as money market funds. And these money market funds and other non-intermediary institutions would lend out the money. So the banks and the institutions would be relying not on deposits, but mostly on a third party. And this is what we call the shadow banking sector. The problem here is banks and households have the safety net of the deposit insurance, which prevents bank runs. However, short-term investments that go through households to shadow banking institutions do not have a safety net that is in the form of deposit insurance. Then short-term investment in the shadow banking institutions had increased because households were looking for higher yields, and they were seeking higher yields because demand deposits have very low interest rates. So there are very low returns on deposits. And households were seeking for higher returns and higher yields in the short-term investment market. And on an international scale, some regions are focused more on producing more and saving, while the US markets are focused more on consumption. In the past, Korean investors were not able to deposit their money in American banks. However, they were at that time able to invest through short-term investment vehicles, which would in turn issue securities to American banks and provide the funding. So an international funding and financing was possible. So the outcome of the situation was, according to Diamond's research, the delegated monitoring role is very important. But the fact was the banks were not able to play that role anymore. So the bank's assets had become insolvent. And second of all, there had been preventive measures and institutions to avoid a bank run equilibrium for deposits, but there was nothing for such runs in the shadow banking sector. Next, in the financial market, in particular, subprime mortgage vehicles were becoming insolvent in July of 2007. And if you see on the chart on the left, the securities that were based on those mortgages, their prices are plummeting, and the price plummet of the shares led to the financing stress on the financial institutions. All of the funds were disappearing. So mortgage-backed securities and vehicles had lost their trust in the market. And these short-term vehicles cannot be rolled over. They suddenly disappeared from the market, and collateral and guarantees that had been provided by most of the banks, they had to bring it onto their balance sheets. And banks would need short-term funds, and they would have to go to the market to obtain short-term funds, but that was becoming a problem. People didn't believe that this was a structural issue because the losses were not as large as everyone was concerned about in the subprime mortgage market. They were thinking that this was just a liquidity issue and the central banks could play the role of the lender of last resort to solve this. But in September 2008, Lehman Brothers collapsed. And this was no longer just a liquidity problem for banks. It was more of a credit risk problem. And this perception began spreading across the market. And in the short-term financing market, the most important product was, of course, the commercial paper, the CPs. So this is a very short-term fund vehicle. These short-term funds were not being rolled over and they were disappearing from the market. And the financial institutions, the institutional investors began buying US government debt. Now, the other way around, so I was up to now explaining the banks and the financial institutions that were providing short-term funds, but the financial institutions that were operating MMFs were going to incur losses, and the market was beginning to understand that, so the households began withdrawing their money. So as you can see in the chart, right after Lehman's bankruptcy, one MMF was incurring losses, and the principal would not be guaranteed, and so the market began losing money, and this was another large-scale run. So this ended up as the U.S. Treasury providing guarantee to the market participants to put an end to this spiraling situation. So in other words, the problems in the shadow banking sector. So the issue in the shadow banking sector is that the flow of money, which had been guaranteed through the lender of last resort by the central bank and the deposit insurance, all of these measures had become futile, and the central bank had to jump in to have us to pull us out of this global financial crisis.
그래서 이제 그럼 과거에 이제
So in the past, the Federal Reserve Board had bailed out a lot of banks. And how can we justify this? How much is this justified? When the financial system and especially the banking system collapses, the large financial institutions that provides it's mostly the small companies and the bank dependent players are much more impacted. So to limit the impact on those small players, the Fed had to intervene. So there are many different tools to help the market overcome these crises. And so the financial systems and the banks have been researched, and their achievements and contribution had led to their winning the Nobel Prize in Economics this year. And a lot of research is also taking place on the basis of that research. Thank you.
Thank you very much. And I invite you to have a seat, and I'll also invite Professor Edling to the stage. And I'll also invite a panelist to join us, Kei-Young Ri, Assistant Professor, Division of Humanities and Social Sciences, Boeing University of Science and Technology. Please join us over there, and Professor Edling here. Have a seat. Now, this was very interesting and extensive, and I'm sorry for interrupting you, but the problem is that you were answering all my questions.
Okay.
So how can I have a discussion if there are no questions left? Maybe I'll start with you.
You mean me or him?
You,
Okay.
Lee. So I would like to hear your reflections. Now you heard two presentations here quite differently, and I know you're working with efficiency in the capital system. And what is your immediate reflection that you're making from what you just heard?
So if allowed, just may I speak in Korean?
Sure.
Okay. 이번 노벨상 같은 경우
In the case of this year's Nobel Prize, I think it has implications for the recent situation. In 2020, we had the COVID-19, and then there is the deterioration of the economic situation afterwards. And so its implications for the real world is really very strong. The financial market, in terms of the real economy, it does not only provide a nominal distribution channels for the funding, but it can have immense impact on the real economy. So maintaining the stability of the financial system would have an immense influence on the long-term sustainable development of the real economy. And so, yes, I think that this year's Nobel Prize winners' contributions have implications for the recent situation. Recently, we have experienced a lot of recessions in the real economy because of the failures in the financial system. So why does financial institutions or systems fail, and what should we do if that happens? I think this study provided very strong implications.
Because it often has very practical implications, or the awards seem to be because they have had very practical implications. Now, these awards were based on papers written in the 80s. About bank runs, but we still have bank runs. We just heard a presentation that they were taking place in 2011 in Korea, a modern society. I have some vague memory of it taking place in Sweden when I was a child in the 70s as well. People running to the bank. I'm not sure.
Only
maybe,
80s too.
Maybe it was on other countries.
Only
Sorry.
80s too. Scandinavian
In
crisis.
the 80s, yeah. So why? So if we knew it, if this groundbreaking paper came in the 80s, why is it still happening?
여전히 금융 시스템에 대해서
Yeah. So stability, there are always concerns about the stability and reliability of the financial system. That is a reason. In particular, financial stability is doubted because the investors who invest their money, from their perspective, I am giving my money to a borrower or to an intermediary, and whether they are doing the due diligence and being very earnest in terms of their investments and management of the money, the credit worthiness is an issue. If there is just one thing that goes wrong in terms of the credit worthiness, then the credit worthiness can collapse. And that is the nature of credit worthiness. So no matter how systems become advanced, if there is a weakness or a vulnerability and investors have some distrust about that, then this can lead to a large collapse. This might lead to doubt about the entire system, and that was what was analyzed by the winners of this year, that this become a systemic issue.
Can I ask you the same question? Why is this still happening?
Yeah, I mean, for me as a sociologist, this last remark about the system and the systemic risk is interesting, because there can never be a foolproof financial system, because the actors that are in the system are there to make money, and to make a lot of money, and as quickly as possible. So they will always look for new ways to extract value. And they will come up with they are creative and inventive, right? So they are always one step ahead, I think, from the regulators. And the other aspect of this year's prize that I find interesting is, that it has so much to do with belief and trust in institutions, and belief about, all kinds of things. And people have irrational beliefs. We can't take that away from them either. And that creates problems for the sector and for the regulators. So.
Is trust and belief and also knowledge and information about the situation as it is, and rumors. I know, Dr. Lee, that you studied how digital development is changing, or the effects of digital development in banking. And it seems, again, these papers are from '83, which is very pre the digital time, and they say something interesting about the system as such. After that came the digitalization, which means faster transactions, more spreading of rumors, if there would be, maybe more friction in some ways, and maybe less friction in some other ways. The banks know their customers less because we don't go to the bank to do our business. How would you say digitalization has affected this, and if it has?
두 가지 측면에서 말씀을 드리겠습니다. 일단
So I can answer that question in two respects. So we talked about why we are experiencing these financial crises. Well, a financial crisis, when it happens, from a general point of view, there is no crisis that takes place that because of well-known risks, but new intermediary methodologies, and under the name of financial innovations, if they come to the market, well, in many cases they do benefit the society, but the unexpected risks and unexpected side effects, when it is thrown, when it breaks out in the society, that consequence is not absorbed well by the system, and so this will lead to a collapse of the market risk, and this can lead to a financial crisis. So this digital transition is taking place in the financial market as well. And so although we cannot simplistically anticipate everything at this point, but the blockchain-based new currencies are talked about a lot, and also the financial products, when they are so unlike in the past, different intermediary functions, digital platforms are intervening, and additional risks arise because of these new entities coming to the market. And so they may bring greater benefits to the society, but there are also potential risks that they bring in. And so we need to thoroughly analyze these risks and be able to anticipate them, and also the contact points with the customers, the banks and the final borrowers. The contact points are lost, and the bank's ability to produce information is weakening. That is true. I think that is quite right. And so, going forward, when new information is produced and the financial institutions and in the financial system, these information, how it is distributed and how it is analyzed, we need to have new insights into this methodology and the process. And the financial regulators, they need to make more effort to really learn about these new ways of operating in the system.
Professor Edling, do you also have a reflection on the digitalization and how that may change?
Not really,
Situation
but
for the
I would,
banks?
in a way, I would expect that the monitoring function would be improved because digitalization creates a lot of new information and data. So, right, you have a richer sort of information set to monitor upon. But that's as far as I would render a guess.
Yeah, yeah, I see. But another for you then, you have studied sociological networks, social networks, through analytical sociology in Swedish industry and violent networks, different social groupings. Are banks also an interesting entity to study? Management level of banks or the banking sector? Is it a sociological subject of interest?
Yeah, sure. Everything is an interesting subject for sociology if there's people in it. I mean, but a sociologist would study banks sort of from another perspective, I guess. Certainly from the management perspective and the relationship between, you know, the board and the CEO and the owners, for instance. But also I guess a big question for a sociologist would be the legitimacy of banks, right? So all these kind of bailout things, that would be something that would interest sociologists because it upsets, you know, people in general that we save banks while you know, tens or hundreds or millions of people have difficult to have ends, meet ends. Those kind of things would be, you know, on the sociologist's dish, I think.
Yeah, yeah. I'm curious on economics as a subject, as a scientific subject. So you know, have a lot of students here, and there are lots of students watching, and maybe they are thinking of what area to choose. And I'm also thinking of the criteria for quality in economic research. Can you say something about that, Professor Edling? About you're in the committee for looking at many different contenders or nominated persons, well deserving, I'm sure, all of them. How do you in the committee make choices? You said a little bit about that in your presentation, but I guess there are some parameters for quality that you hold very high.
Yeah, I mean the key thing are the nominations, right? So there will never be a prize suggestion if there is not a nomination for it. So that's the most important thing, and the people that are invited to nominate to the prize are you know, academics all over the world. Basically professors at economics departments, they make up the core chunk of it, and then some other people outside of academia and in other neighboring disciplines. So it really is, in that sense, sort of a scientific democratic process in a way, right? But it's also not the popular vote, so it's not the nomination that gets the most nominations that get a prize. I think, I mean, commenting on economics from an outsider, it's an interesting, as a social science is an outlier, if you wish, because it has this really strong paradigm that keeps it all together. You know, so an economist here and an economist there, they immediately understand one another. They have the same language. They have the same sort of core assumptions about the world and about the economic system and about, you know, the set of ways that you can model economic behavior with, and that's extremely powerful. But it's also, so it creates an inclusion for the field, but it's also excluding in a way, because it's hard to penetrate that sort of shield, if you wish. But yeah, I think economics is in a very good state. It's turning more and more empirical, which is also interesting. It used to be a very highly theoretical, still is, but for a while it was almost more mathematics than economics. And now with new access to new types of data, there's an extremely interesting development in empirical economics. So, you know, if one would venture a guess, I think that's where most of the exciting development will be in the coming 15 years, maybe.
Yeah. Sung-Yup Lee and Keung Lee, both of you.
이성엽 박사님 그리고 이기영 교수님 두 분께
you are-
여쭤보겠습니다.
You are obviously the leading examples of the quality of economic research in Korea. No, you wouldn't say so
Obviously not.
yourself. But I'm curious as to what you think, how strong is economic science in Korea? How popular is it? I know a lot of Korean people, young people that very much want to be engineers. And there's a lot of talk in the economy about production, manufacturing, innovation, maybe not so much about the economy, but how strong is the economic sciences as an area for studies and research here in Korea? Let's start with you, Kim.
Okay. 좀 대답하기 쉽지 않은.
So that's a difficult question to answer. But to try to attempt to answer it, recently, Korean economists, not only Korean economists, but also Korean economists who are researching overseas are producing a lot of significant research. Over the past 2 to 3 decades, we have seen much advancement, and on Korean soil as well, we are seeing many good papers being published in prominent journals. So Korean economists are quite active overseas and at home, and they're contributing significantly to the field of study. Whether I am a member, whether I am also contributing, well, that remains to be seen. So the practical issues, to look at the realistic issues in economics, I believe that Dr. Lee can answer this question better. But anyway, until last year, I was also a member of KDI. And one thing that I understood was that all of the expert knowledge that we learned in our PhD programs, they are actually providing very strong empirical and theoretical foundation for policy development. And though the public might not understand this, but I would like to think that the public understand this, but anyway, the field of economics is very much impactful on the policies in terms of regulation and the financial market as well. I believe that is quite impactful in the market as well. And I would like to agree to what was just said. In Korea and abroad, a lot of Korean-born economists are producing very valid and significant research. And in particular, compared to the past, the general quality and volume is all both being increased and enhanced. So I have a very bright outlook on Korean economics. And in terms of economics research, this provides a framework for policy building and how much it contributes to actually implementing policies. In that regard, as was mentioned by Professor Lee just now, it is much more impactful than the general public might believe. And in terms of developing policy and analyzing and assessing the impact of such policy, economists are very actively participating. So they are contributing to actual policy. And this trend has to be upheld and reinforced going forward. Many Korean students, you mentioned that they are interested in engineering. And I do believe that there's more demand for engineering studies rather than economic studies today. But nevertheless, modeling societal phenomena and providing empirical evidence to explain phenomena and to build policies and evaluating the impact of policies, the economist's role is very significant indeed. And a lot of people find meaning in that endeavor. And I see many young scholars who are interested in making a career out of this field. And they will continue to form the future of Korean economic study.
Really the answer of an economist to say that there is a need for more engineers than economists. It's not self-defeating, it's perfectly logical, of course. Very interesting. Well, thank you very much. There are really good questions online as well, but I'm sorry that we don't have time to turn to them. So thank you very much, all three of you. And I'm going to invite Dr. Lena Eskilsson back to the stage as well. But I can ask you off the stage first. But thank you very much for coming to this session. Thank you.
So thank you very much, Professor Edling, and thank you very much, Dr. Lee, for your kind participation, extensive presentations, and really interesting discussion. And also, of course, thank you, Dr. Ree, for your contribution to the interesting discussion. I will not try to summarize all the things that has been said here today, just a few comments. I think, Professor Edling, it was really interesting to get some insight into the process of selecting the winners, the most rigorous peer review process in the world. And also thank you for encouraging the students that research can start really early in life. And Dr. Lee, thank you for discussing a Korean perspective on financial crisis. It was really interesting to hear that. I would also like to say that anyone interested in the future as a researcher in the fields of economics is lucky that there's still much more to do within the field and to discover in this area, not the least when it comes to regulations. And our Nobel Memorial Program will continue later on with a session on literature. So I would like to invite all of you to come back here at 7 o'clock local time. I think it's 11 European time, and follow this session. Otherwise, I wish you a good reminder of the day, and thank you for today, all of you. And in Korean, I think it's 감사합니다. Thank you.